keep doing what you've been doing. Keep investing your money. Keep dollar cost averaging like you have been doing. Keep managing your money with a budget. Don't get fearful. Don't get scared. The Fed really wants us to enter into a recession. The Fed has been trying to break this economy for well over a year now. And when I say break this economy, I mean soften the economy so that ultimately inflation goes down. And the best way that they've been able to do this so far, guys, is to raise the federal funds rate. Because raising the federal funds rate means that the cost of money is more expensive to borrow, and that deters people from spending so much money and borrowing so much money. And ultimately, when that happens, the demand for goods and services starts to go down. And when the demand for goods and services start to go down, prices start to go down. And that's what the Fed has been hoping would happen over the last year or so, right? By raising these federal funds rates. And so the Fed wants to see a recession. The textbook version of a recession is 2 straight quarters of a down GDP, right? Gross domestic product. Now, they want to see that because that's going to be an indication to them that things are shrinking. And now that's going to trigger, or supposed to trigger, inflation to go down quicker. Now, here's the kicker though, guys. The big kicker on all this is, and what they don't mention quite often is, during the pandemic, the Fed, especially at the very beginning of the pandemic, the Fed was pumping the economy full of money, pumping money into the economy by doubling the size of their assets on their balance sheet, right? They doubled the amount of assets they had in the beginning of the pandemic. And they did that by selling a bunch of bonds, right? Mortgage-backed securities, what have you. They increased their assets, and that added money into the U.S. economy. And at the same time, guys, they were handing out stimulus checks to everybody who looked like they needed a stimulus check. And they were handing out PPP loans and free money for this and free money for that. They were flooding the economy with money to stimulate the economy. Now, since the end of 2021 and into 2022, they wanted to scale that back, and they wanted to get rid of some of the assets that they had added to their balance sheet. And at the same time, increase interest rates to deter people from spending so much money. So now the Fed is backtracking on what it was doing at the start of the pandemic, right? So remember, the pandemic happened, everybody was shut in, nobody could buy, nobody could spend. The government passed laws that said you don't have to pay your rent, you don't have to pay student loans, you don't have to pay any of these things. And guess what? The economy needed an injection of money. And so the Fed said, let's flood the economy with money. Now the Fed is saying, whoops, that flooding of the economy with money has made an impact on inflation. It made inflation go up crazy because people had the money to spend. And when people have the money to spend, people tend to spend. And that spending and spending and spending, it made prices go up and up and up. Now they're saying we want to bring prices down. How do we do that? Now we want to have a recession. Now we want to see the economy shrink significantly. And so part of that was 10 straight Fed fund rate hikes in a row, in the hope that everybody would stop spending, we'd see some downturn, we'd see some unemployment go higher. That stuff hasn't happened, right? We know that unemployment right now is at a 50-year low, 3.4%. But the Fed wants to see that unemployment go higher because more unemployed people mean less people spending money, means ultimately less demand for goods and services, means ultimately prices will go down. That's the theory. Guys, I just recently did a video about the meeting minutes from the last Federal Reserve meeting from their Federal Open Market Committee. The FOMC is the committee that actually sets the rate for the federal funds rate. Now, one of the things that was talked about at that meeting that appears in their meeting minute notes was the whole conversation around where do we go from here? Do we continue to increase interest rates into June and July and then again in September? Or do we at some point pause the interest rate hikes and allow some of that lag time to catch up? And lag time just means when they institute a policy, like they raise the federal funds rate, it's going to take a few months for that policy to actually show up in the economic activity. It's going to take some time, some lag time. So they had all those discussions, and those discussions are documented in those meeting minutes. But the interesting thing is the committee of 12, there's 12 folks on the FOMC, the committee of 12 was sort of split down the middle. Half of them said, yeah, we should keep continuing to raise rates. The other half was saying, no, we should probably put a pause for now. So that was pretty interesting. Now, me personally, guys, I strongly believe that they're going to actually raise rates again for an 11th straight time by 25 basis points, or 0.25%. Now, that's my opinion based on reading the notes from the last meeting and listening to what they're saying in the media right now. However, hey, I could be wrong. And let's get something else clear on this video, guys. The CPI, or consumer price inflation rate, is about 4.9%. About a year ago this time, guys, it was 9%. What the Fed is doing is actually working. It's just working much, much slower than the Fed had anticipated that it would work, right? So inflation is actually going down. Now, the core PCE, which excludes energy and excludes the prices of food, and it's a broader look at the overall inflation picture, that's a little more sticky right now. That's around 4.5, 4.6%, and it hasn't changed but about 0.2 or 3 percentage points in the last 5 or 6 months. So the core PCE is being sticky. It's the inflation indicator that is not quite seeing what the Fed really wants to see in terms of getting down to a 2% inflation rate. But my question is this, guys. Is the Fed actually looking at the wrong indicators when making its decisions? Are they so focused on the fact that, well, the labor rate is still 3.4%, the lowest it's been in 40 years or so, and we haven't seen labor budge. We need to see labor go up to 3.8 and 4% and 4.5% before we're satisfied that the U.S. economy, in terms of inflation, is moving down to our 2% inflation rate that we want. Now, that's what the Fed is saying, but I'm saying, is that the wrong indicator? Because inflation is going down slowly but surely. It's not like inflation is still stuck at the 8 and 9% that it was last year. It's not there. So perhaps there's no need to continue to focus on labor as your primary indicator. Maybe there's no need to focus on pounding away at the federal funds rate, continuing to raise it and raise it and raise it, if we see that inflation is actually coming down. Maybe there's no need for the Fed to be so aggressive with these rate hikes. My other question, or my other concern, is perhaps the Fed, who is owned by larger banks, may be feeling the effects of all of these years of having these super duper duper low interest rates, right? They were serving these banks these super duper low interest rates for many, many years, guys. Now, to be clear about what I said, the Fed is privately owned. It's a privately owned entity that's essentially owned by the large banks. And the Fed's low interest rate policy for the last several years leading up to the pandemic was wonderful for the price of assets, right? Because it helped push the value of assets up. But it was terrible for bank profits, because higher interest rates is how banks make their money. Banks make their money on interest rates. So low interest rates was terrible for banking profits for many, many years. And perhaps the Fed now is using inflation as a reason to finally sort of normalize interest rate policies for the largest banks. I'm just throwing that theory out there, guys, because high interest rates equal higher profits for banks and the entire U.S. banking system. Now, also, guys, don't get it twisted. I think there's probably some ego involved in this whole thing as well. The Fed and the Fed chair, Jerome Powell, they don't want to be known as the Fed that fumbled the ball during and after the pandemic. The Fed chair, Jerome Powell, he wants to be known, granted, he wants to be known as the Fed chair that was able to maneuver and guide the U.S. economy through the pandemic and through the highest inflation it has seen in 40 plus years. So I'm sure that that's in the back of the mind of the Fed and the Fed chair as well. Guys, in my opinion, the Federal Reserve is bent on hiking up interest rates until something in the economy breaks. And that could mean more layoffs, higher unemployment, and it's definitely going to mean a break in the GDP. In other words, a recession. They really, really, really want to see a recession. They want to see 2 straight or more quarters of GDP going down. And they talked about that in their last meeting. They talked about what's going to happen, the projections for quarter 3, quarter 4, and into quarter 1 and 2 of next year. And they're looking at a recession during that time. And I think they want to see a recession that really looks like a real recession. Not just this mild recession of 2 straight quarters of a down GDP and everybody is still working and the economy is still going strong. I don't think that's what they want to see. I think they want to see a real recession that feels like a real recession to the U.S. economy. Now, there's a Fed meeting coming up soon. I think around June 14th or so is when we're going to get the announcement from the Fed on what they're going to do with their federal funds rate. And like I said, I think they're going to raise it because I don't think they want to let up too soon or give the appearance that they're letting up too soon. If they've said that we're going to have a mild recession later this year, they're going to do what it takes to get to that mild recession by later this year. The stock market has already priced in a 25 basis point hike for the next meeting that the Fed has, so we'll see what happens. Your job, as I always say on this channel, is to keep doing what you've been doing. Keep investing your money into the stock market. Keep going, okay? Don't stop. Things are might get bleak in the next few months, the next third and fourth quarter this year or first quarter next year. Keep going, keep investing, keep dollar cost averaging like you have been doing, putting a certain amount in at a certain interval of time every single week, every single 2 weeks, every single month. Keep your resume updated just in case we see jobs begin to tumble, right? Keep increasing your skills and making your skills more valuable as you can get them. Keep managing your money with a budget. Stay after your financial goals like you have been doing. Guys, right? Just because you know what's happening in the economy doesn't mean you let that deter your plans and what you're doing, and you don't get fearful. Don't get scared. Don't watch CNN and MSNBC and Fox News all day and look at the breaking news ticker that's going down there at the bottom of the screen, right? Don't get caught up in all that because news is there to scare you into watching their broadcast so they can make more money, right? News and social media, all that stuff are for-profit companies, so they want to make money. And the more they put fear in you and scare you about the U.S. economy, the more they're able to get you to watch. And that adds money to their bottom line. So be careful about that. Don't buy into the fear. And keep paying down your debts on items that are depreciating in value, right? Bad debts. Keep paying those things off because ultimately you want to free up money so you can invest more. And of course, as always, be on the lookout in this type of market on ways you can increase your money. And the obvious is to keep investing, right? If the Fed raises the interest rates by 25 basis points in their upcoming meeting, guess what's going to happen to the stock market? Stock market is going to go down. That's your opportunity as an investor to purchase, to keep purchasing, right? Not to sell, right? You don't sell when things go down. So hey guys, on this video, I wanted to give you my reasons for why I believe the Fed wants to see a recession. Guys, do me a favor, smash this like button if you got anything out of the video. And also, please consider subscribing to the channel if you're not already a subscriber. I really appreciate you guys checking out this video. I appreciate your support on this channel as well. Stay tuned to this channel for more U.S. economy updates in plain language. Hey, the best person to take care of the old you is the young you. Take care of yourself, guys, and take care of other people. Until the next video, peace.